Welcome to our comprehensive guide on financial statements and analysis. In this video, we'll explore the essential documents that businesses use to track their financial health and learn how to analyze them effectively. Financial statements are the backbone of any organization's reporting system, providing a clear snapshot of performance and position. Whether you're a student, professional, or entrepreneur, understanding these statements is crucial for making informed decisions. Let's begin by defining what financial statements are and why they matter in the world of business and finance. There are several key types of financial statements that every business prepares. The most common are the balance sheet, income statement, and cash flow statement. Each serves a unique purpose and provides different insights into a company's financial status. The balance sheet shows assets, liabilities, and equity at a specific point in time. The income statement details revenues and expenses over a period, revealing profitability. The cash flow statement tracks the movement of cash, highlighting operational, investing, and financing activities. Understanding these documents is the first step in financial analysis. Balance sheet is a fundamental financial statement that provides a snapshot of a company's financial position at a specific date. It lists assets, liabilities, and shareholders' equity, showing what the company owns and owes. Assets include cash, inventory, and property, while liabilities cover debts and obligations. Equity represents the owner's residual interest. By analyzing the balance sheet, stakeholders can assess liquidity, solvency, and capital structure. This statement is essential for investors, creditors, and management to evaluate the company's stability and growth potential. Income statement, also known as the profit and loss statement, summarizes a company's revenues and expenses over a specific period. It reveals whether the business is generating profit or incurring losses. Key components include sales, cost of goods sold, operating expenses, and net income. By examining the income statement, analysts can identify trends in profitability, efficiency, and cost management. This statement is vital for understanding how well a company performs operationally and for making strategic decisions about growth and investment. Cash flow statement tracks the movement of cash in and out of a business. It is divided into three sections: operating, investing, and financing activities. Operating cash flow shows the cash generated from core business operations. Investing cash flow reflects purchases and sales of assets, while financing cash flow covers borrowing and repayment of debt and issuing equity. This statement helps stakeholders understand how a company manages its cash, which is critical for maintaining liquidity and funding future growth. Statement of changes in equity details the movements in shareholders' equity over a period. It includes items such as net income, dividends, and capital contributions. This statement helps investors and management track how equity evolves, reflecting the company's financial decisions and performance. By analyzing changes in equity, stakeholders can understand the impact of profits, losses, and distributions on ownership value. It's an important tool for assessing long-term financial health and shareholder returns. Notes to financial statements provide additional information and context that help users understand the numbers presented. These notes explain accounting policies, detail significant transactions, and disclose risks or uncertainties. They are essential for a complete and accurate interpretation of financial statements. Analysts and investors rely on these notes to gain deeper insights into the company's operations, financial decisions, and potential challenges. Always review the notes for a fuller picture of the business's financial health. Financial statements are crucial for decision-making in business. They provide transparency, facilitate accountability, and enable stakeholders to assess performance and risks. Investors use them to evaluate potential returns, creditors to judge creditworthiness, and managers to plan strategies. Accurate and timely financial statements build trust and support regulatory compliance. Without them, it would be difficult to measure progress, identify issues, or make informed choices. Their importance cannot be overstated in the world of finance. Various stakeholders rely on financial statements for different purposes. Investors analyze them to assess profitability and growth prospects. Creditors examine them to evaluate the company's ability to repay debts. Management uses them for planning and control, while regulators ensure compliance with standards. Employees may review statements to understand job security and performance. Each user interprets the information based on their interests, making financial statements a universal tool for business communication. Preparing financial statements involves collecting, organizing, and summarizing financial data according to accounting standards. The process starts with recording transactions, followed by adjusting entries, and finally compiling the statements. Accuracy and consistency are vital, as errors can mislead stakeholders. Accountants use specialized software and follow regulatory guidelines to ensure reliability. Proper preparation lays the foundation for effective analysis and decision-making, making this step essential in the financial reporting cycle. Financial statements are prepared in accordance with established accounting principles, such as GAAP or IFRS. These principles ensure consistency, comparability, and transparency across organizations. They dictate how transactions are recorded, classified, and reported. Understanding these principles is fundamental for interpreting financial statements accurately. They provide a common language for business, enabling stakeholders to compare performance and make informed decisions. Adherence to accounting standards is critical for credibility and trust. Financial statement analysis involves examining the numbers and trends within the statements to evaluate a company's performance. Analysts use various techniques, such as ratio analysis, trend analysis, and comparative analysis. The goal is to identify strengths, weaknesses, opportunities, and threats. By interpreting the data, stakeholders can make better decisions about investing, lending, or managing the business. Effective analysis transforms raw financial data into actionable insight. Ratio analysis is a powerful tool for evaluating financial performance. It involves calculating and interpreting ratios from financial statements, such as profitability, liquidity, and solvency ratios. These ratios provide quick insights into a company's strengths and weaknesses. For example, the current ratio measures liquidity, while the return on equity assesses profitability. Ratio analysis helps compare companies, track progress, and identify areas for improvement. It's a cornerstone of financial analysis. Profitability ratios measure a company's ability to generate profit relative to sales, assets, or equity. Common ratios include gross margin, net margin, and return on assets. These ratios help stakeholders assess how efficiently a company turns revenue into profit. By analyzing profitability ratios, investors and managers can identify trends, benchmark against competitors, and make strategic decisions. High profitability indicates strong performance, while low ratios may signal issues that need attention. Liquidity ratios evaluate a company's ability to meet short-term obligations. Key ratios include the current ratio and quick ratio. These metrics show whether a business has enough assets to cover its liabilities. High liquidity ratios suggest financial stability, while low ratios may indicate risk of insolvency. Liquidity analysis is crucial for creditors and management, as it affects the company's ability to operate smoothly and avoid financial distress. Solvency ratios assess a company's long-term financial stability and ability to meet debt obligations. Examples include the debt-to-equity ratio and interest coverage ratio. These ratios help investors and creditors evaluate risk and sustainability. High solvency ratios may indicate excessive leverage, while low ratios suggest conservative financing. Solvency analysis is essential for understanding the company's capital structure and potential for growth or distress. Trend analysis involves examining financial data over multiple periods to identify patterns and changes. By tracking revenues, expenses, and profits over time, analysts can spot growth, decline, or stability. Trend analysis helps forecast future performance and support strategic planning. It's particularly useful for detecting emerging issues or opportunities, enabling proactive management. Consistent trends indicate reliability, while sudden changes may require further investigation. Comparative analysis compares financial statements across different periods or companies. This technique highlights changes, improvements, or declines in performance. By benchmarking against industry peers, businesses can identify strengths and weaknesses. Comparative analysis supports decision-making by providing context and perspective. It's a valuable tool for investors, managers, and analysts seeking to understand relative performance and competitive position. Common size statements express financial statement items as percentages of a base figure, such as total assets or sales. This approach simplifies comparison across companies and periods regardless of size. Common size analysis highlights proportional relationships and trends, making it easier to spot anomalies or changes. It's widely used in financial analysis to enhance clarity and comparability, supporting more informed decision-making. Horizontal analysis examines financial statement items over time, focusing on dollar and percentage changes. This method reveals growth, decline, or stability in key areas such as revenue, expenses, and profits. By analyzing changes year over year, stakeholders can identify trends and evaluate performance. Horizontal analysis is useful for spotting patterns and making strategic adjustments, ensuring the business stays on track toward its goal. Vertical analysis involves evaluating financial statement items as a percentage of a base figure within the same period. For example, each item on the income statement is shown as a percentage of total sales. This method highlights the relative size of expenses, profits, and other items, making it easier to assess efficiency and cost structure. Vertical analysis is a straightforward way to compare performance and identify areas for improvement. While financial statements are invaluable, they have limitations. They may not capture intangible assets, market conditions, or future risks. Accounting policies and estimates can affect accuracy and comparability. Financial statements provide historical data which may not reflect current realities. It's important to supplement analysis with other information such as industry trends and management commentary for a complete picture of the business. Qualitative analysis complements financial statement analysis by considering non-numerical factors. This includes management quality, industry conditions, competitive landscape, and business strategy. Qualitative insights help explain the numbers and provide context for financial performance. Combining quantitative and qualitative analysis leads to more accurate and meaningful conclusions, supporting better decision-making in business and investment. Financial statement fraud occurs when companies intentionally misrepresent their financial data. This can involve overstating revenues, understating expenses, or hiding liabilities. Fraud undermines trust, damages reputations, and can lead to legal consequences. Auditors and analysts use various techniques to detect fraud, such as ratio analysis and reviewing notes. Vigilance and ethical practices are essential for maintaining integrity in financial reporting. Auditors play a critical role in ensuring the accuracy and reliability of financial statements. They review and verify the data, assess compliance with accounting standards, and identify potential errors or fraud. Independent audits build confidence among stakeholders and support regulatory requirements. The auditor's opinion is a key indicator of the quality and trustworthiness of financial statements, making their work essential for financial transparency. Forecasting involves projecting future financial performance based on historical data and trends. Businesses use forecasting to plan budgets, set targets, and anticipate challenges. Techniques include trend analysis, regression, and scenario planning. Accurate forecasting supports strategic decision-making and helps companies prepare for growth or downturns. It's an essential part of financial management and planning. Interpreting financial statements means understanding what the numbers reveal about a company's health and prospects. Analysts look beyond the figures to assess profitability, liquidity, solvency, and efficiency. Interpretation requires context, such as industry benchmarks and economic conditions. By combining analysis and interpretation, stakeholders gain actionable insights that guide investment, lending, and management decisions. Reporting involves presenting financial statements to stakeholders in a clear and accessible format. Companies use annual reports, regulatory filings, and investor presentations to communicate results. Effective reporting builds trust, supports transparency, and meets legal requirements. It's important to ensure accuracy, clarity, and completeness in all financial communications. Good reporting practices enhance stakeholder confidence and support business growth. Technology has revolutionized financial statement analysis. Modern software automates data collection, calculation, and reporting, improving accuracy and efficiency. Tools like spreadsheets, analytics platforms, and artificial intelligence help analysts uncover insights faster. Technology also supports real-time monitoring and forecasting, enabling proactive management. Embracing technology enhances the quality and speed of financial analysis, making it indispensable in today's business environment. Summary: financial statements and analysis are essential tools for understanding and managing business performance. We've covered the main types of statements, analysis techniques, and their importance for various stakeholders. Accurate preparation, thorough analysis, and clear reporting support informed decision-making and business success. By mastering financial statements and analysis, you can unlock valuable insights and drive growth. Thank you for joining us on this journey through the world of finance.